Welcome to The Deep Dive. Today, we're getting into something really fundamental for real estate investors: financing. Figuring out how to actually pay for those properties.
Yeah, absolutely. And it's not one size fits all, right?
Definitely not. Whether you're eyeing, say, a single family rental, maybe scaling up to apartments, or even commercial stuff.
Or short-term rentals, retail.
Yeah.
The list goes on. Each one needs a kind of tailored approach to financing.
So our goal today is to really break down the crucial bits of financing these investments quickly but thoroughly.
Exactly. We want you to walk away with a clear picture of the options. And we're definitely looking beyond just, the standard home mortgage you might be familiar with.
Right. The investment world has its own set of tools.
That's it. Tools specifically for building that portfolio.
Okay, let's dive in then. When we talk about property loans, I guess the first thing that springs to mind for most people is traditional banks.
Yep, that's the common starting point.
What should investors know about going down that road?
Well, traditional bank loans, they're familiar, sure. But for investors, they often come with some pretty significant hurdles.
Hurdles like what?
Get ready for a deep dive into your personal finances. Banks usually want a lot of documentation.
Ah, the paperwork mountain.
Exactly. Think years of tax returns, detailed income proof, job history, the works. And they look really closely at your debt-to-income ratio.
And that whole process, I imagine it takes a while. Time isn't always a luxury for investors.
Precisely. You could easily be looking at 45, maybe 60 days for approval, sometimes even longer.
Wow. And in a fast-moving market, 60 days? That could mean missing out completely.
You got it. That delay can absolutely cost you good opportunities.
And aren't there other sort of caps or limits that can slow down an investor's growth?
Oh, absolutely. Banks often put limits on how many properties you get mortgages on at one time.
Which really puts the brakes on scaling up a portfolio.
It really can. Plus, they usually want you to have pretty substantial cash reserves just sitting there. And then there's the DSCR, debt service coverage ratio.
Right, I've heard of that. Explain that a bit.
So it basically compares the property's expected income, the net operating income, to its total debt payments. Banks have strict minimums for this ratio.
And that can be a problem even if the investor themselves is financially solid.
Yeah, it's a kind of hidden trap sometimes. Maybe the rent projections dip slightly, or you have an unexpected vacancy right after buying. Boom, you might not meet the bank's DSCR rule, even if you personally qualify. It can kill the deal.
So, okay, traditional loans might have decent rates sometimes, but these limitations, the time, the property limits, the DSCR, they sound like real roadblocks for active investors.
They definitely can be.
Which leads us, I guess, to the alternative: private lending. How does that change the game?
This is where things get interesting. Private lending fundamentally shifts the focus. Instead of putting your personal finances under a microscope, they concentrate much more on the property itself, its value, its potential to make money, or, increase in value.
So it's about the asset more than the borrower's W-2.
Largely, yes. And that shift unlocks some really key advantages for investors.
Okay, like what? What are the big benefits here?
Well, for starters, usually no income docs needed. No digging through years of your tax returns.
Seriously, no tax return.
Often, no. And crucially, no DSCR calculations. That whole ratio we just talked about often doesn't apply in the same way.
Wow, okay. That sounds like it cuts out a ton of hassle and paperwork.
It does, which leads directly to another huge benefit: speed.
Right, you mentioned the delays with banks.
Exactly. Private lenders can move fast.
Yeah.
Closing a deal in, say, 8 to 13 days isn't uncommon.
8 to 13 days. That's incredibly fast compared to 60.
It's a massive difference.
Oh,
that
yeah.
speed is gold in competitive markets, or for time-sensitive deals.
Makes sense.
And another thing, remember those limits banks put on the number of properties.
Yeah.
Private lending generally doesn't have those same restrictions, so the potential to grow your portfolio, it's basically unlimited from the lender's perspective.
Unlimited portfolio potential. Okay, that's a big one for serious investors looking to scale.
It really is. Plus, you often find more flexibility. Private lenders can sometimes structure deals more creatively to fit unique situations.
And getting an idea of terms, is that faster too?
Much faster. You can often get what's called a term sheet, basically a quick summary of the main loan terms like rate, amount, repayment, sometimes the same day you ask. Approvals are generally way quicker overall.
So the whole picture is faster decisions, faster closing, more flexibility, easier scaling.
That sums it up pretty well. It empowers investors to act decisively.
Okay, great overview of the contrast. Let's get into some specifics now. Different loan types for different investment plays. How about we start with rental property loans? What's their niche?
Right. Rental property loans. These are really built for the long-term buy and hold investor.
The bread and butter for many.
Exactly. You'll often see features like 30-year fixed terms, which is great for predictable payments over the long haul. Rates are usually competitive too.
And the qualification, is it easier, like you mentioned, with private lending?
Often, yes. Many of these lean towards that streamlined private lending model, so potentially no income verification, no DSCR hurdles.
Makes sense. And what kinds of properties do these typically cover?
Think single-family homes, your duplexes, triplexes, fourplexes, so 2 4-unit properties, townhouses, even condos, as long as the plan is to rent them out.
Got it. Perfect for building that stable rental income stream. Now, what about bridge loans? The name suggests something, well, temporary.
That's exactly what they are. Short-term financing, usually something like 12 to 36 months.
And what's the purpose? Why use a short-term loan?
They're designed to bridge a gap. Maybe you're buying a property that needs work, a fix and flip.
Okay.
Or maybe it's a value-add play where you buy, renovate to increase its value, and then plan to refinance into a long-term loan.
Ah, so you use the bridge loan to get control and do the work.
Precisely. They're also great for time-sensitive deals where you just need to close now and figure out long-term financing later.
Any other key features of bridge loans?
Often they have interest-only payments during the loan term. That helps keep your monthly costs down while you're maybe renovating and not collecting full rent yet.
That could be helpful for cash flow.
Definitely. And sometimes the loan can actually include the funds you need for the renovations rolled right in.
Interesting. So a tool for transformation, really. Let's scale up again. Commercial property loans, what's different here?
Right. Commercial covers a much broader range. We're talking retail spaces, office buildings, industrial warehouses.
Medical centers, self-storage.
Exactly. Mixed-use properties, too. Because these deals are usually bigger and more complex, the loan terms tend to be longer, maybe 5 to 25 years.
Okay.
And you might see initial interest-only periods here as well.
Yeah.
The really big difference, though, compared to, say, residential rentals, is the focus. With commercial, it's heavily weighted on the property's financial performance, its income, its occupancy, its overall stability.
Less about the borrower's personal income, more about, does this building make money?
You got it. The property really has to prove its own financial strength.
Okay. Now, what about multifamily properties, like apartment buildings? Are those just lumped under commercial?
Technically, yes. Anything with 5 or more units is usually considered commercial real estate, but there are often specialized loan products just for multifamily.
Ah, okay, so specific multifamily loans.
Yeah. They try to strike a balance, offering competitive rates, but also flexible terms that kind of understand the unique cash flow patterns of large residential rentals.
Still focused on the property's performance, I assume.
Absolutely. Property performance is key. And importantly, for multifamily, you can often find both short-term bridge loans, maybe if you're buying an apartment complex that needs upgrades.
Right, the value-add approach again.
And also long-term permanent financing for properties that are already stable and throwing off consistent cash flow.
Good to know there are options for different stages of a multifamily investment. Okay, one more category you mentioned sounds really specific. Foreign national investor options. Tell us about those.
Yeah, these are pretty specialized. They're financing solutions designed specifically for people who aren't U.S. citizens but would want to invest in property here in the States.
How does that work if they don't have things like a U.S. credit history or social security number?
That's exactly the point. These programs are built recognizing that international investors won't have that stuff, or maybe U.S. tax returns either.
So the underwriting is different.
It has to be. But the goal is still to provide competitive loan terms for qualified foreign buyers. There are options for investors from many different countries, and sometimes even programs tailored for specific regions, like maybe European investors.
That really opens up the U.S. market to global capital.
Fascinating. Okay, we've toured the different loan types. Now let's circle back to qualifying, especially focusing on that private lending model we highlighted. What does the paperwork actually look like? What do investors need to gather?
Right. And this is where you really see the difference from traditional banks. It's usually much less demanding.
Less paperwork is always good news. Definitely. Typically, you'll fill out a basic loan application. You'll need to provide the details on the property you're buying, like the purchase contract.
Or if it's a refinance.
Then usually the loan payoff statement for the existing mortgage. You'll need basic personal ID, of course. And if you're borrowing through an entity, like an LLC.
Which many investors do.
Right. You'll need info on that entity structure. And then, for purchases, you do need to show you have the down payment funds. Verification of funds is pretty standard.
Okay, application, property info, ID, entity docs if needed, proof of down payment. What about the stuff that's usually not required compared to a bank?
That's the key part. Usually, no tax returns.
Wow.
No income verification like W-2s or pay stubs. No detailed employment history checks. Often, no extensive personal financial statements.
That really streamlines things. Less digging into your personal life.
Exactly. It makes the process faster and, frankly, less intrusive for many investors.
So, if they're not focusing so much on my personal income stream, how do private lenders decide if it's a good loan? What are they looking at?
Great question. It boils down to a few core things about the deal itself. First is loan to value, or LTV.
Right. How much of the property's value they're lending.
Exactly. It's the loan amount as a percentage of the appraised value. Typically, you'll see LTVs maybe in the 70–75% range. It can vary, of course.
So the investor still needs a decent down payment, like 25–30%.
Generally, yes.
Yeah.
That gives the lender a cushion and ensures you have skin in the game. Lower LTV, by the way, while meaning more cash up front for you, is less risky for everyone.
Makes sense. What else besides LTV?
Location, location, location. They carefully look at the property's location and the conditions in that specific market. Is it growing, stable, declining?
Local economic health matters.
Huge factor. And of course, the physical condition of the property itself is assessed. For bridge loans, the viability of your exit strategy is critical.
Your plan to pay back the short-term loan, you mean?
Right. How are you getting out? Selling it, refinancing it? They need to see that the plan makes sense.
How do they verify value and condition?
Well, appraisals.
Yep, professional appraisals are key. They'll also look at market comps, what similar properties are selling for, and growth trends in that specific neighborhood. It's really about evaluating the strength and potential of the investment itself.
Okay, assessing the asset. Now, you also mentioned something earlier. No-doc loan programs. That sounds almost too good to be true. What's the deal there?
Yeah, it sounds very appealing. No-doc investment loans are basically the most streamlined option out there.
Meaning
They really minimize the borrower documentation. The loan decision is almost entirely based on the property, its value, its income potential, the LTV.
So what specifically gets eliminated in a no-doc scenario?
Typically, you're looking at no tax returns needed, no personal financial statements, no income verification at all, no DSCR math, not even digging through your bank statements usually.
Wow. So how does that work? Based purely on the appraisal and maybe the lease agreements?
Pretty much. It's heavily reliant on the LTV and the appraiser's valuation. And for rental properties, the existing or projected rent income compared to the proposed payment. It expedites closing like crazy.
Who typically uses these?
It can be great for investors with complex income, maybe multiple businesses, self-employed folks whose tax returns don't fully reflect their cash flow, or just people who value financial privacy.
Got it. A powerful option for specific situations. Okay, so we've got a handle on the financing tools. How do we weave this into a smart overall investment strategy? Let's talk market selection. What should you be looking for in a market?
Choosing the right market is probably step one for success. It's fundamental.
So what metrics matter?
You want to look at population growth, definitely. Are people moving to this area? And maybe even who is moving in, what are the demographics?
Young professionals, families, retirees, that impacts rental demand differently.
Exactly. Job growth and employment diversity are huge.
Yeah.
You don't want a market reliant on just one industry.
Yeah, that's risky.
Analyze income levels. Are they rising? Can people afford the rents you'd need to charge? Look at housing supply versus demand. Is it tight? Oversupplied?
Vacancy rates and rent trends too, I assume.
Critical. Are rents going up? Are properties staying full? Also look for signs of local economic development, new businesses, infrastructure projects. And don't forget the rules, understand the local regulations, landlord-tenant laws.
That can vary a lot place to place.
It really can. So the sweet spot is usually a market with a diverse economy, steady growth, job creation, and ideally regulations that aren't overly burdensome for landlords.
Makes sense. Do your homework on the location first. Now, once you've picked some promising markets, how do you approach actually building the portfolio? Are there common strategies?
Yeah, portfolio building is all about being strategic. Diversification is usually a good idea.
Meaning
Don't put all your eggs in one basket. Maybe mix property types, some single family, some small multifamily. Maybe invest in a couple of different geographic areas.
spreading the risk.
Exactly. And diversifying your approach, too. Some common strategies you see. There's the cash flow focus.
Okay, what's that?
That's where you buy stable properties in established markets, mainly for the steady rental income they produce. Reliable, predictable.
The slow and steady approach?
Kind of. Then there's the value add approach. That's buying properties that are underperforming, maybe need repairs, better management.
And you fix them up to force appreciation and increase rents.
You got it. Higher risk, potentially higher reward. Then there's the appreciation play, betting on growth.
Buying in up-and-coming areas, hoping the market lifts your values significantly.
Right. More speculative, relies on market timing, and lots of people use a hybrid strategy, maybe some core cash flow properties, mixed with a few value add or appreciation plays.
Finding a balance.
Exactly. The right mix for you depends on your goals, how long you plan to invest, how much risk you're comfortable with, and how much time you have for management.
And the financing ties into this.
Absolutely. The right loan for a stable cash flow property might be different from the best financing for a quick fix and flip using the value add strategy. Aligning financing supports each part of your portfolio.
Got it. Strategy and financing have to work together. Okay, last big piece. Risk. Investing always has risks. What are some key risk management tactics investors should use?
Prudent investors are always thinking about risk. It's crucial. First off, cash reserves. Always have some rainy day funds.
For vacancies, unexpected repairs.
Exactly. Things happen. Thorough tenant screening is huge. Avoiding problem tenants avoids a lot of headaches and financial loss.
Good tenants are worth their weight in gold.
They really are.
Yeah.
Proper insurance is non-negotiable. Protects against damage, liability.
Oh, basics.
Right. Diversification, like we just discussed across markets. Property types that spreads your risk. Have contingency plans. What if the market turns? What if interest rates jump on your variable loan?
Thinking through the what-ifs.
Yes. And, very relevant to today's chat, structuring your financing wisely. Don't over-leverage yourself. Balancing debt and equity protects you in downturns and can boost returns when things go well.
Finding that right leverage level.
It's key. And finally, good property management, whether you do it yourself diligently or hire reliable pros, is a major risk mitigator day to day.
So managing risk is multifaceted.
It is. And picking the right loan, the right financing structure is absolutely a core part of that risk management puzzle.
This has been incredibly helpful, really clarifying the landscape of investment financing. If you had to boil it down, what's the single biggest takeaway for our listeners?
I think the key thing is this: really understanding the range of loan options out there, especially realizing how private lending can offer speed, flexibility, and scalability. That knowledge itself can give you a significant edge as an investor.
It opens doors that maybe traditional routes keep closed.
Exactly. It allows you to act faster and potentially build bigger or more diverse portfolios.
And it's not just knowing the options exist, but using them strategically.
That's the crucial next step. Aligning the right financing with the right property, your specific goals, and your own tolerance for risk. That's where the magic happens.
Fantastic. Loads to think about there. And for you listening, as you look at your next potential real estate deal, really consider this. How could choosing your financing more strategically unlock opportunities you might have thought were out of reach? What new possibilities does this understanding open up for your own portfolio growth? That's something to chew on until our next deep dive. Thanks for joining us.